Look, Nvidia is a phenomenal business, but here's the thing. Even great businesses can be terrible investments if you overpay. Let's break it down. Nvidia is the undisputed heavyweight champ of the AI infrastructure boom. Their GPUs, like the H100, aren't just powerful, they're foundational. Hyperscalers like Microsoft, Amazon, and Google rely on them for AI training at scale. Nvidia dominates with over 90% market share in that niche. But here's where it gets dangerous for investors. Everyone already knows that. This is not a secret. Nvidia's advantage in hardware is real. Their software stack, CUDA, CUDNN, TensorRT, creates enormous switching costs. Developers are locked in. That's a moat. I'm not debating the business quality. The issue is the price. Let's talk numbers. Last year, Nvidia grew revenue by over 120%. Free cash flow surged past $27 billion. Gross margins hovered around 75%. Numbers that look more like software than hardware. So far, so good, but here's what the market is pricing in: perpetual dominance. Let's not forget, Nvidia has been cyclical before. In the crypto boom, they soared. In the bust, they got crushed. The risk here isn't that the company implodes. It won't. The risk is that growth decelerates even slightly, and the multiple contracts fast. That's when investors learn the difference between a great company and a great stock. Now, let's talk capital allocation. Nvidia is doing the right things. They're investing heavily in R&D, rolling out new chip generations, and expanding their data center footprint. They're also repurchasing shares, though at current valuations that's debatable in terms of effectiveness. Their balance sheet? Rock solid, minimal debt, loads of cash. Financially, this is a fortress. But I keep coming back to this. At $3 trillion, what are you really buying? Are you buying future dominance? Or are you buying the last 2 years of explosive growth priced into eternity? At nearly a $3 trillion market cap, Nvidia trades at over 30x sales. Not earnings, sales. And over 60x free cash flow. To justify that, Nvidia has to keep growing at insane rates for years, without a single hiccup. That's where I get cautious. Look, I'm not blind to the upside. The TAM, total addressable market, is huge and expanding fast. AI training, inference, edge computing, autonomous vehicles, robotics, digital twins, you name it. Nvidia's touching everything. And Jensen Huang? He's a visionary. Few CEOs understand the hardware-software loop better. The company is vertically integrating, owning its own networking stack like InfiniBand, to reduce dependency on third parties and tighten its grip on data centers. But here's what experience teaches you. Narratives can outrun reality. Today, we're in a moment of euphoria. AI is the story. Nvidia is the arms dealer. And retail and institutional money is chasing the same theme. That's how bubbles form. Let me put it this way. Nvidia is no longer a bet on execution. It's a bet on perfection. And in investing, perfection rarely delivers the returns you hope for. There are also geopolitical risks, especially with export restrictions to China. And competition is heating up. AMD, Intel, even hyperscalers like Google and Amazon are developing custom AI chips. Nvidia's lead is real, but the world is catching on. Margins and growth may come under pressure faster than bulls expect. So what's my verdict? Nvidia is a Tier 1 business, no doubt. Massive moat, exceptional leadership, enormous tailwinds. But as a stock, right now, it's priced for godhood, and I'm not in the business of worshiping tickers. Want my full breakdown? It's on Nora and Bob Compounding. Link in bio. Drop your thoughts below. Are we riding a rocket ship or playing musical chairs?